DRD Gold has reported an 8% rise in gold output for July to September compared to the previous quarter. Releasing its quarterly financials and operational review, the company says it sold 17% more gold than in the prior quarter. Another positive metric was operating profit, surging by 52% to 79.7 million rand, but the company suffered a headline loss for the period. To explain what's gone on behind the numbers, I'm joined in studio by Neil Pretorius. He's CEO of DRD Gold. Thank you very much for joining us, sir.
Thank you for having me.
Revenue was up 18%, operating profit up 52%, but you suffered a headline loss. Can you please explain the drivers behind these numbers?
Yeah, the headline loss is really driven by non-cash items. We spent a lot of capital over the last few years, and obviously the capital is amortized over life of mine, and some of those numbers came through. On the whole, though the net cash position was very favorable. We made enough money to pay off a substantial portion of debt that was outstanding and maintained a very healthy cash balance towards the end of the quarter. So we're actually quite encouraged by these results.
To what extent did Rand weakness assist in boosting your revenues?
Oh, it does definitely help. If you look at gold price in dollar terms, then it's declined in, I think, more than 20% year on year. Whereas in South Africa, we're fortunate in the sense that the gold price declined only by about 7%. So with inflation, which industry inflation is around 10%, and the, let's say 7 or 8%, in real terms, I think the margins have shrunk by only about 18%. It sounds a lot, but compared to the global environment, it's actually still quite favorable.
Now, you did mention slightly earlier that you've reduced your capital expenditure, and that's because of investments that you made in previous years. What did you invest in those previous years, and are those capital investments bearing fruit?
Absolutely, yes. Our business involves the recycling of mine tailings, so there's a lot of processing that takes place. As a consequence, we need to make sure that we have infrastructure to sustain the volume requirements or economies of scale of our business. The advantage that we do have, though, is once you've spent the capital, most of the capital is spent, which is different compared to other mines, your conventional mine where you have ongoing sustained sustenance capital, or you're opening up and development costs. So we have periods during which we spend a lot of capital. We spent close to 2/3 of our market cap in the last 8 years. We've come to the end of that investment cycle now. Now hopefully we'll start to pick the fruits of or enjoy the fruits of our endeavors.
Cost containment is always a tricky one for you guys, but I see your costs did rise by 24% in the quarter. What was behind that? Well,
there again, that is an all-sustaining cost number, and it's pretty much on the back of a very attractive non-cash credit that we could bring against an environmental liability last year. Insofar as all-in cash costs are concerned, in other words, the amount of money that we made, we actually managed to reduce the cost of producing gold per kilo by about 15,000 Rand quarter on quarter. So we maintained a healthy all-in cash margin quarter on quarter.
Right. And what sort of impact, if any, have the current or the recent electricity supply constraints had on production for you guys?
Absolutely nothing. We are, usually if there is going to be a reduction or if there's going to be an interruption, either because of maintenance or because there's pressure on the grid, we get due notice from Eskom. And we haven't had any significant breaches. I think the last trip out that we had was in December of last year, and it happened to be between Christmas and New Year, so I think everybody was on holiday, and that's maybe why we were without power for a few hours.
And still sticking with costs in Eskom, they're going to get a higher or institute a higher tariff next year. To what extent will that disturb or affect your cost line?
It will definitely affect the cost line, and I think that's also a reality of being in a weaker Rand environment, is that your industry costs or your industry inflation is slightly higher than your actual inflation. You've got to drive those, or you've got to drive your efficiencies towards those costs, though. And that's one of the reasons why we make substantial investments in technology, because the fixed overhead is fairly high, and as a consequence, we need to make sure that we derive optimal value out of every ton of material that enters our plant.
Now, by virtue of the fact that you're a CEO of a gold company, you have to be a gold bull, but there are lots of people out there who say gold just has no future. What's your prognosis for that
I think for the near term, I think if your business is under pressure now, it'll probably remain under pressure for the next 18 to 24 months. I don't think that there's going to be significant upward pressure on the gold price, simply because the dynamics that pushed the gold price so much higher 4 years ago are still there. They're just far more serious now, and yet we don't see any upward pressure on the gold price as such. So they're probably going to have to enter a period of supply squeeze before we'll see any significant increases in the gold price. And I think that supply squeeze will probably start manifesting in about 24 months, because a lot of companies globally, those that are producing in dollar and not in rand, those that don't have the incidental benefit of our currency, a lot of those are underwater, and the ones that are not spending enough sustaining capex. And I think their production profiles will start coming under pressure in 18 to 24 months. And if at the time there's still similar demand for gold, we might see a bit of supply pressure.
Neil, thank you very much for your time.
Thank you.
That was Neil Pretorius, he's CEO of DRD Gold. On to